Rocketlab just agreed to buy a company bigger than itself.
An $8 billion deal announced at the end of June for a satellite network that's been in orbit since the 90s. And that's just the biggest headline on a stock. It's already up huge this year, still unprofitable, and still waiting on a rocket that keeps slipping its launch date.
Bull case, bear case, and everything that's actually scheduled to happen next. All in one episode. This is RKLB, Rocketlab.
Welcome back to OrderFlow, the show that breaks down the signals that actually move markets. Insider buying, institutional flow, and the milestones that separate story stocks from real businesses. I'm Ryan.
And I'm Matt. Standard disclaimer, this content is for informational and entertainment purposes only, not financial advice. The host may hold positions in the securities discussed now or in the future. Always do your own research and consult a licensed financial advisor before making investment decisions. Normally, we split a stock like this across 3 episodes: bull case, bear case, milestone tracker. We're doing something different today. Rocketlab's story moves fast enough and the Iridium news is big enough that we wanted to get the whole picture in front of you in one sitting. So buckle in, this one runs long.
Let's set the table first. Rocketlab reported first quarter revenue this year of $200 million, up 63.5% year over year, with a record backlog of $2.2 billion across more than 70 contracted missions. The stock has had a massive run, and in the middle of all that, on June 29th, they announced they're acquiring Iridium Communications for roughly $8 billion.
So today's roadmap, what the business actually is, why people are bullish, why people are skeptical, and then everything on the calendar you can actually go check for yourself. Let's start with what Rocketlab actually is, because a lot of people still think of it as the other SpaceX and leave it there.
It's really 2 businesses stitched together. Launch, the Electron rocket, which has flown over 50 orbital missions, and Space Systems, which builds satellite components and full satellites for other companies. Last quarter, Space Systems actually brought in more revenue than Launch, $137 million versus $64 million. So this is already less of a rocket company and more of a space infrastructure company than people give it credit for.
That split surprises people. Why is Space Systems the bigger piece already?
Because Launch is a one-time event, but satellite components, solar panels, separation systems, reaction wheels, flight software, get sold into every mission, whether Rocketlab launches it or not. They're a supplier to other launch providers too. So the Space Systems business scales with the whole industry's launch cadence, not just their own.
And the launch cadence itself has been climbing.
Electron flew 21 missions last year, and they're now launching roughly every 11 to 13 days. 2026 is on pace to beat that. Gross margin came in at 38% on a GAAP basis, and they're sitting on more than $2 billion in liquidity. This isn't a pre-revenue story stock. It's a real fast-growing business that happens to also be unprofitable, which we'll get to.
What's actually driving the margin higher quarter over quarter?
Mix and scale. As Electron's launch cadence goes up, the fixed costs of running the launch pads and the manufacturing line get spread across more missions. And on the Space System side, they're increasingly selling higher value, higher margin components instead of one-off custom builds. Both trends point the same direction.
What's the actual bull thesis beyond revenue is growing?
Vertical integration. Rocketlab controls the whole chain. Rocket manufacturing, launch services, satellite components, on-orbit operations. That lets them sell a customer an end-to-end mission instead of just a ride to orbit, which is stickier and higher margin than being a pure launch provider.
And that's showing up in who's actually signing contracts.
Defense and national security money is a huge piece of this. They're building toward the Golden Dome missile defense architecture through the Space-Based Interceptor program, and they're already sitting on an $816 million contract with the Space Development Agency. In May, they flew a Space Force mission called Victus Haze, from getting the launch order to liftoff in 16 hours and 42 minutes, a record for responsive space launch. That's the kind of proof point that wins the next contract.
Why does responsive launch specifically matter to the Pentagon?
Because the old model, that to book a launch slot months or years in advance, doesn't work if you need to replace a satellite that just got knocked out or respond to a fast-moving situation. Being able to go from order to orbit in under a day is a capability almost nobody else has demonstrated. And it's exactly the kind of thing that turns into follow-on contracts rather than one-off wins.
So the bull case isn't just rockets are cool?
No. It's a company with a $2.2 billion backlog, expanding margins, and a growing list of governments and primes who'd rather buy the whole mission from one vendor than stitch it together themselves.
Is the defense business at all concentrated in one program, or is it spread out?
It's spread across multiple agencies and multiple contract vehicles. Space Force, the Space Development Agency, and now the Golden Dome architecture, which itself is a multi-year, multi-contractor build-out. That diversification matters because it means Rocketlab isn't dependent on any single program surviving the next budget cycle to keep that revenue flowing.
And then there's Neutron, which is really the next leg of the bull case.
Neutron is Rocketlab's medium-lift, reusable rocket, designed to carry 13,000 kilograms to low Earth orbit, which is roughly 43 times what Electron can carry. It opens up an entirely different customer base. Bigger satellites, constellation deployment, national security payloads that Electron simply can't lift. Rocketlab already has 5 Neutron launch agreements signed before the rocket has even flown once.
Why would customers commit to a rocket that hasn't flown yet?
Because if it works, it's priced to compete directly with the mid-size launch market that's currently dominated by one or two providers. Customers who are worried about being over-reliant on a single launch vendor have an incentive to lock in a seat on a credible second option early, even before it's proven. The same way early customers signed on to Falcon 9 before it had a long track record.
And Wall Street's actually pricing some of that optionality in already.
Morgan Stanley has an overweight rating on the stock with a base case price target of $105. But their bull case, which factors in Neutron actually working and the Iridium deal paying off, goes all the way up to $293. That's the spread analysts are working with right now. This could be a modestly valued growth stock, or it could be a generational space infrastructure company. And which one it is depends almost entirely on execution from here.
So the entire bull case really compresses down to one variable.
Pretty much. Everything else, the backlog, the margins, the defense contracts, is already real and already showing up in the numbers. Neutron is the one piece that's still a promise, not a result. Which is a good bridge into the bear case.
Now let's take the other side, because there's real reason for caution here too.
Start with the multiple. This stock trades at roughly 60 times forward sales. That's an extraordinary multiple for a company that's still unprofitable. They posted a $45 million net loss in the first quarter alone, and management isn't guiding to profitability until around 2028.
How does a company fund a 2-year plus gap to profitability at that scale?
By selling stock. They raised $450 million through an at-the-market equity program in the first quarter alone. That's real, ongoing dilution, on top of whatever new shares get issued to fund the Iridium deal itself, which is partly a stock transaction. Every dollar of new equity is a claim on the company that existing shareholders didn't have before.
Is there a bear case number for what this stock is actually worth today?
One bearish model actually puts fair value as low as $18 a share, nearly 80% below where it's trading, even assuming a full decade of double-digit growth. You don't have to agree with that number to see the point. At this multiple, a lot has to go right for a long time, just to grow into the price. There's very little room in the current valuation for anything going wrong.
How does that multiple actually compare to other names in the space and defense tech world?
It's on the high end, even for that group. Traditional aerospace primes trade at a fraction of that multiple, and even other high-growth space names tend to sit well below 60 times sales. The bull argument is that Rocketlab deserves a premium because it's actually executing. The bear argument is that deserves a premium and deserves this specific premium are two very different claims, and the second one is a lot harder to defend.
And anything going wrong brings us to the rocket the whole bull case leans on.
Neutron was originally supposed to fly well before now. In January this year, the first stage tank failed during qualification testing. A manufacturing defect traced back to a section that was hand-laid by a contractor, while Rocketlab's automated fiber placement machine was still being brought online. That pushed the target launch window out to the fourth quarter of this year.
And this rocket has already had more than one delay before that.
It has. Every slip chips away at credibility with the customers who've already signed launch agreements, and every slip pushes the medium lift revenue the bulls are counting on further out. A new rocket program slipping isn't unusual on its own, but combined with a 60 times sales multiple that's already pricing a Neutron, succeeding roughly on schedule, there's not much cushion left for a fourth delay.
Who benefits if Rocketlab keeps slipping?
Blue Origin and Firefly are both working on rockets in a similar weight class, and every month Neutron sits in qualification testing is a month they get to close the gap. If Neutron misses the fourth quarter window again, or a competitor gets to orbit first, the stock's multiple has real room to compress. Some bearish scenarios have this retracing back towards $60 if that combination plays out.
So to sum up the tension here, the bull case is priced for Neutron succeeding roughly on schedule, and the bear case is built on the very real possibility that it doesn't.
That's exactly it. And underneath both of those is a company that's still burning cash and still diluting shareholders to get there, regardless of which way Neutron goes.
So that's bull and bear. Now let's get into what's actually on the calendar, starting with the biggest one, because this is the story that changes what kind of company Rocketlab even is.
On June 29th, Rocketlab announced a definitive agreement to acquire Iridium Communications for $54 a share in a cash and stock deal valuing Iridium at roughly $8 billion. Bigger than Rocketlab's own market cap at the time it was announced. Iridium shareholders get $27 in cash plus Rocketlab stock, with the exchange ratio collared between $67.50 and $112.50 a share.
And strategically, what does bolting on an already operating satellite network actually get them?
It's the missing piece of the vertical integration story. Rocketlab builds the rockets and the satellites. Iridium already operates a global satellite communications constellation, with spectrum rights and services like direct-to-device and positioning, navigation, and timing already generating revenue today. Instead of spending a decade building a constellation from scratch, Rocketlab buys one that's already flying and already has customers.
What's the actual risk in a deal this size?
Integration risk, mostly. Buying a company bigger than yourself, partly with stock, means a lot of new shares hit the market, and a lot of operational complexity gets absorbed all at once. If Iridium's business underperforms after the deal closes, or the two companies' cultures and systems don't integrate cleanly, this could end up being a distraction layered on top of everything else Rocketlab is already trying to execute.
When does this actually close?
Management is targeting mid-2027, and it still needs Iridium shareholder approval and regulatory clearance. So this is a 19-plus month setup. Plenty of time for both companies' fundamentals and the market's appetite for the deal to shift before it's final.
Does the collar structure on the stock portion protect shareholders on either side?
Somewhat. The collar means the exchange ratio adjusts within that $67.50 to $112.50 band, so Iridium holders aren't wildly exposed if Rocketlab's stock moves a lot before closing. But outside that band, the deal's actual value to Iridium shareholders starts to drift from what was announced on day one. It's a long runway, and stock deals with collars like this can look very different in month 18 than they did on announcement day.
Okay, what else should people actually be watching with real dates attached?
3 things. First, second quarter earnings land. August 6th, management has already guided revenue of $225 to $240 million, with EGA AP gross margin in the 33 to 35% range. That's the next real data point on whether the growth rate the bulls are counting on is holding up.
Second,
Neutron's first launch, still targeted for the fourth quarter of this year. The major structures, fairing, second stage, thrust structure, have all completed qualification and are moving into final integration and test. That's real progress since the January setback, but targeted is doing a lot of work in that sentence until there's an actual launch date on the calendar.
And third,
the regular drumbeat of Electron launches and new contract announcements. That's the thing that doesn't make headlines individually, but is the actual proof the business is compounding while Neutron and Iridium play out in the background. Watch the launch cadence more than any single announcement.
Is there anything on the Iridium timeline specifically worth watching before that mid-2027 close?
Yes, the Iridium shareholder vote. That's the first real checkpoint on whether their side sees this as a fair deal or a giveaway, and it'll likely happen well before the close date. A contentious vote or a competing bid emerging in the meantime would be an early signal the deal isn't as clean as the announcement made it sound.
If you had to rank those three by how much they'd move the stock, where would you put them?
Neutron first, that's the one the bull case actually depends on. Earnings second, because it's the closest, most concrete checkpoint on whether the growth story is intact. And the Electron drumbeat last, not because it doesn't matter, but because it's the steady baseline everything else gets layered on top of.
So, how do you actually grade this one going forward?
Watch three things. Does Neutron hit its fourth quarter window without another slip? Does the August 6th earnings print land inside guidance? And does the Iridium deal keep moving toward that mid-2027 close without a regulatory snag or shareholder fight? 2 out of 3 keeps the bull case intact. Miss more than one, and the 60 times sales multiple gets a lot harder to defend.
Bull case, a vertically integrated space company with a $2.2 billion backlog, a defense pipeline that keeps winning contracts, and now a satellite network that skips a decade of build-out. Bear case, unprofitable, diluting shareholders, trading at a nosebleed multiple, and still waiting on the rocket the whole growth story depends on.
That's RKLB. We'll be back to check the scorecard as these dates hit.
That's OrderFlow. Follow us wherever you're listening, and we'll see you in the next one.